I want to thank everyone for joining us today for our third quarter 2021 quarterly review. I'm joined today by Andy and Bijal, who, in addition to covering our normal material, will also touch on a couple other pertinent pieces of information. But I want to start by thanking everyone for this honor. So we were recognized by CNBC as one of the top 100 firms. This is a reflection of really you. And on behalf of everyone at the Bernie Company, I want to thank you. So one of the topics that we'll cover today will be inflation. That's a topic of interest with the increase recently in that. It's interesting how age dependent the reaction is to this. If you've been an investor for, say, the last 20 years, you may not have a lot of firsthand experience with the challenges of inflation. If you're a little bit older, particularly if you were around as an adult in the 70s and early 80s, inflation has a very different and much more scary meaning. So we're going to cover that in some detail. Bijal will cover that in some detail. Right now, in large part because of the supply chain interruptions, we also have a big economic headwind that is bringing on stagflation, which is the combination of high inflation and low economic growth. And that's actually the worst combination of all. It's heartening to understand that both the Fed and investors, if you look at the performance of the stock market and the bond market, they're all right now treating those effects as transitory. So if that proves to be the case, then we'll move past this, just as we have other challenges in the past. And again, Bijal will cover that in more detail. So I'll hand that off at this point to him.
Thank you, Lowell. Before I go ahead and get started, what you'll see on your screen today is, as Andy mentioned, we're trying a new service. We want this to be an interactive webinar. So if you scan the code that you see on your screen right now, it'll allow you to type in your questions and also see the questions that others are asking. If you see questions that others are asking that you would like us to address, please go ahead and click on the thumb button, and it will prioritize that question, and we will get to the questions but during and at the end of this webinar itself. So I'll give that a moment, and then I'll go ahead and get started. Thanks, Andy. As we normally do, what I'll take a look at first is our quarterly outlook in terms of asset class returns. At first glance, if you look at the numbers, it would have looked like it was a very flat and boring quarter. But in reality, it was quite the opposite. We had a very strong start to the quarter, but then a sharp sell-off in September, and when you look at asset classes across the board. In terms of the US markets and international developed markets, ended almost flat. But what is obvious on this screen is what happened to emerging markets. For the quarter themselves, they were down 8%. The primary driver of this was because of the impact of China. Right, so China is currently going through a volatile year with new regulatory cycles affecting internet and education companies. And then the special headlines over the last couple of months have been that the corporate bond market has been negatively impacted by speculation of property developer Evergrande, as it might default on its $300 billion financial obligations. This made headlines. However, this was not new news. If you looked at the bond prices for Evergrande, they're in US dollars, they're already trading at 25 cents on the dollar. It just made the headlines and was reflected in last quarter's kind of overall returns. Over on the bond market, it did what it was supposed to do. Rates have started to trickle up. However, the overall returns were relatively flat. I think bond investors are starting to get used to the environment. Investing in bonds is for principal safety versus just principal and growth itself. And looking at the longer term returns, what we will see is asset class returns still tend to be in line with what we've seen historically. So on the next slide, what you'll see is the US market continues to lead the way, right? So US investors have been rewarded one-year returns over 30%. But what's surprising here, if you look at the 1-year number, is what's happened to global real estate. A year ago today, people were saying that corporate offices were going to be abandoned, real estate market's going to crash, right? Quite the opposite happening. I think we're all starting to adapt to kind of a hybrid model in terms of where we're going to work. Some of us will be working at home some of the time, but we'll also be going into office some of the time too. This has been reflected a nice recovery in the global real estate market itself. It just goes to show that whatever you expect, sometimes the exact opposite can happen. And looking at the much longer term numbers, the 10-year number, what we see in this trend has been true for the last decade or so. The US market continues to outperform the international markets. However, as we move into an environment where investors are asking the question, where is their value? Some say that the US market might be slightly overvalued at this point, gives us consideration to be including international investment in a well-diversified portfolio. So if you've only focused and have been in the right spot over the last decade or so, focusing on US investments, now could be the right time to asking, is my portfolio really diversified, and should I be considering international investing within a well-diversified portfolio itself? On the next slide, what we'll talk about here is just what's been happening, right? We've had a strong first half, right, for sure. And again, as I mentioned before, we here in the US specifically, we've seen a nice recovery in the residential and commercial construction market. And then also what's been driving a lot of this has been the consumer. This has been the story ever since COVID first hit, all the way to 18 months later. We've had high savings rates, strong balance sheets, and I think we just crossed over, when you look at the net worth of the US consumer, just crossed over the $140 trillion mark for the first time. It just goes to show that we've been tightening up our personal balance sheets by paying down debt and increasing our savings rate. On the risk that we see, we continue to see the Delta variant, right? Vaccines are rolling out slower than expected, but we are making progress when we look at this globally. As Lowell mentioned, we do also have stories of supply chain issues. Right? I'll share kind of a personal story. For my parents, I was looking to buy a Honda CR-V. Going into the dealership, I was told that, sure, I could get a car. It might take 30 to 45 days. But in terms of, and I was ready to do my negotiating, and they said, oh, there's no negotiating now. You must be willing to pay $3,000 to $5,000 over MSRP to purchase this car. The good news was that they said, if you don't need this car right away, by the end of the year, beginning of next year, supply strengths will contract, and that you will have a choice of being able to buy the right color car for your mother. And perhaps at that point, you'll have the negotiating power to negotiate the price itself. So we do look at this as this being transitory. This is just a temporary effect in terms of as supplies kind of work their way through the channels. And we think that this will start to erode by the end of this year. I think is it's what most were expecting. I think we're now looking into the beginning part of next year itself. And then there's always DC, right? So we've got politics in DC. There continues to be negotiations on the infrastructure and social spending bills. And the question becomes, how are we going to pay for this in terms of increased taxes on the corporate? And right now what's been produced or proposed is higher taxes for individuals, and they've said for high income earners, right? This topic alone, we can spend hours talking about what we have done. And my colleague Adam next week will be presenting a topic, will President Biden's proposed tax law changes impact you? So be sure to sign in and listen to that webinar next week. So with all of this, as Lowell mentioned, on the next slide, let's talk about is inflation, right? So what is inflation, first of all, and how has it impacted us over the decades, right? So inflation is the average price level of a basket of goods and services in the economy and the increase that we find, most commonly known as the CPI or Consumer Price Index, right? Inflation now has gone over the Fed's target of 2%, as the September CPI report showed that we're currently running at just over 5%. So looking at this historically on the slide, you'll find that if you're a retiree now, you definitely remember the 1970s in terms of what we called hyperinflation, right? And then ever since then, decade over decade, kind of inflation's just started going lower and lower to where we are today. So going from having are experiencing declining inflation to increased inflation does bring a little bit of a shock to the system itself. But as Lowell had mentioned, we do believe that this to be transitory as supply issues kind of work their way through the channels themselves. On the next slide, or yeah, go ahead on the next slide. In terms of, what are the other drivers? As we look at interest rates. So during the 1970s, what drove hyperinflation was just the Fed had to be very aggressive to combat inflation by raising interest rates aggressively, right? Starting the decade at just over 6%, and we climbed all the way up to 15% in the early 1980s. And ever since then, we've been experiencing a declining interest rate environment, right? So this has led to what Lowell had mentioned, next slide, that people are talking about stagflation. And stagflation is when interest rates are, stagflation, inflation rates are high, economic growth is low, and unemployment remains steadily high. Right? So today we still have relatively low unemployment, where even with the most recent data, that employment currently is at under 5% at 4.8%. So the questions that have been proposed are that after 2 consecutive disappointing job reports, raising wages, inflationary pressures are worrying investors. Are we in an environment of stagflation like we saw in the 1970s, right? But also in the 1970s, what they also came up with was something called the misery index. This was the sum of adding the unemployment rate and inflation rates together. And today we are nowhere near the levels that we were back then. So we'll have to pay attention to how the Fed reacts. They do have a lot of ammunition in terms of being able to raise rates should they need to. I mean, we're seeing that we are at an all-time low in terms of interest rates themselves. We started the 10-year treasury this year started at just under 1%, and today we're at about 1.62%. So they do have a lot of ammunition to combat temporary inflation itself. We are always asked in terms of what asset classes will do the best when there is inflation. So again, for those of us that were investors, and most likely those are early retirees of today, remember the 1970s very clearly, where we had very high inflation. And looking at asset class returns, stocks as a whole generated just under a 6% rate of return. This was the worst performing asset class out there. Bonds, however, did outperform with a 7% rate of return, and gold was a great inflation hedge with a 30+% rate of return. But what's interesting, when people try to draw comparisons of are we in the same type of environment, I'd have to say we're not, especially when we think about what bonds will do moving forward, right? This bonds performed extremely well because rates were at 15%, as we saw on the earlier slide, where today we're at 1.5%, right? So in an environment where inflation was running in the 1980s at 5%, we saw both stocks and bonds do well. We may not be in that same environment moving forward. On the next slide, what we'll see is people will ask, well, if rates are starting to go up, what does that mean for the stock market? Okay, we understand that bonds are going to go down. We've been kind of primed to hear that over the years as interest rates have plateaued and starting to go up, I should say. But in reality, when interest rates are going up, generally speaking, that's a very positive thing for economic growth, right? So as long as rates are not going up only to combat inflation, if we're looking on the slide here on line number 3, rates were going up to combat inflation. Yes, the stock market did go down, but in many other instances, dating back from 1962 to current, in a rising interest rate environment, that typically is actually a very positive thing for equity investors. I think what becomes important, and Andy will touch upon this, is when you're an equity investor, where are you investing, or are you just not following the crowd itself, right? Over the last decade, it feels like you could have just almost, like they said back then, the tech days, closed your eyes, throw a dart, and watch the market go up. Same could have been said if you were just invested in large growth companies over the last decade and watch your portfolios go up. Where moving forward, we'll need to be more selective in understanding what types of companies we're investing in. Companies that have strong balance sheets, low exposure to debt, should tend to outperform in the coming decades themselves. So again, the question that I've been asked many times before is that, where are we kind of in the economic cycle? What inning are we in? For those of you that know me, I was born and raised in the Northeast in Connecticut. I'm a Boston sports fan. So if I look and think about the Red Sox, we're in the middle of a postseason run, right? We're not at the beginning, we're not at the end. And especially after last night's game, I fell asleep and only to wake up to see the headlines this morning that we lost really badly. But that doesn't mean the season's over, right? It's the same thing that can be said when it comes to investing as a whole. So it's really important to kind of put things in perspective in terms of longer term returns. And on the next slide, what we'll see is, historically speaking, looking at real returns of different asset classes. So this is taking into consideration Professor Jeremy Siegel's chart dating back the last 200 years. And what we can see from this is that the one asset class that has the most consistent rate of return is equities, right? You can see early on, gold and dollar kind of moved hand in hand until it was unpegged, and you can see the divergence there. But a dollar invested in gold today would only be worth about $4 adjusted for inflation. Bonds kind of go up and down with interest rate cycles. You can see this most recent leg up was really because interest rates have been going down over the last 20 years, as I mentioned in the earlier slides. But then you take a look at equities and what they've done, the most consistent performance over a long period of time. So that being in mind, right, there are plenty of uncertainties in the market itself, right? We should view these as increased volatility. However, it's important to have a portfolio that's aligned with your long-term goals. Have a plan in place that you can avoid the temptation to be either all in or all out. If you have any questions, please reach out to one of us and we'd be more than happy to discuss the risk of your portfolio and any adjustments that need to be made. With that, I'll turn it over to Andy.
All right, thank you, Bijal. As anyone who's been on one of these webinars before, you know that we like to start macro and then go down to different levels and before we start talking about the investment strategy itself. So I'm going to close us out here talking more specifically about what we're doing in response to a lot of those things that Bijal and Lowell were talking about before. The first thing I like to show is this chart that is, we show this a lot. We like to call it the wave chart. And what we do here is we roll return differentials between size and style over various time spans. So you can really visualize what we mean when we say size cycle, or style cycle. So in this chart, we're looking more specifically at style. And when the bar is above the origin and turns blue, those are when value is in vogue. When it falls down and troughs and gets below the origin, it's in gold, and that's when growth is in favor. And so what we know is really over the past 3 or 4 years, really starting in 2016 and going till the end of 2020, growth had a stranglehold on the market, and it was relatively difficult to be a value investor. But if you listen to our webinars in the past or some of our other comments on this, you know that our expectation was that in the 2020s, we'd see a very different market dynamic. And our expectation was that value would regain its day in the sun. And that's exactly what's happened. So once we got to the very beginning of 2021, value stocks really began to take off. So what you can see here is it was a pretty strong rolling 12-month period for value relative to growth. So, it's nice and it's easy when you can just invest in the NASDAQ or the largest mega cap stocks and achieve strong stock returns. But unfortunately, that's not how the market tends to operate over the long term. So we've begun to see some lesser known stocks, those value names, really take off kind of at the expense of your Apples or your Microsofts that have plateaued for various parts of the year. Not saying they've done poorly, they just haven't done as well as value. And I think there's really 3 main reasons why you can feel good about leaning in towards value, as we are currently in both our size and style responsive strategy and the master portfolio. And those reasons are, for one, we're currently in a value phase. So what we know is the best predictor for the next 12 months in terms of what phase we're going to be in is simply look at what phase are you currently in. So we're pretty strongly and pretty clearly right in the middle of a value phase, and that's one reason to feel good. The other reason is another thing we've talked about a few times, and that's just valuations. So when you look at value stocks as a group and you look at growth stocks as a group, what you see is the relative valuation of value stocks is very cheap still relative to growth, even after these last 12 months. And lastly, as Bijal showed, interest rates are, basically as low as they can be. They've been held near zero for some time now. And that matters because when you own a share of a stock, what you really own is a claim on the future stream of that company's earnings discounted back to today. So when the discount rate, which is commonly used as the Fed funds rate or something associated with it, when that is low, valuations can be supported, or high valuations can be supported. The problem is that when interest rates start rising, the discount rate starts rising. So that future stream of earnings becomes less valuable, and it's harder to justify such high valuations. So what we know is today, since growth companies are relatively expensive to value, and the stock market is not a monolith, there's pockets that are expensive and there's pockets that are cheap. And right now, value looks cheap. We know that value companies have the potential of being hurt more than, growth companies have the potential of being hurt more than value companies with increasing interest rates. So the story with regards to size is a little bit more muddy than it is with value. We're quite confident in our value tilt, and in fact, we're as far tilted towards value as we'll ever be. Size is a bit of a different story, and it was complicated because the decade of the 2010s was really a period where the cycling dynamic broke down, and there were really short trends. There wasn't much of a magnitude one way or the other. So really much of that decade, we were neutral with regards to size. The one thing that had the potential to break that trend, though, was a big bear market. And obviously, we got that back in 2020 with the COVID crisis. And as expected, we saw large companies do relatively better than small companies. And that's a normal trend we see because large companies tend to be better capitalized and smaller companies can be a little riskier. So they do tend to sell off a little bit more. And so what we did in response to the big sell-off was that we actually leaned into small caps, because small caps, while they do sell off the most during the actual bear market, they also recover the strongest during the subsequent recovery. And that trend did take place really starting in the fourth quarter of 2020. So if you look at the trend here, we're still below the origin. So the past 36 months still kind of lean in towards large cap stocks a little bit, but the trend is moving higher towards small caps. We are leaning into small, especially small value right now, but we're a little bit less confident in that positioning. So we're not at a max bet with regards to size, but we are leaning that direction a little bit. The one big thing that we did do in response to the market environment in the third quarter is we changed a piece of our stock selection methodology. So our traditional stock selection model is, the premise of it is based on the fact that there are certain factors that are correlated with long-term excess returns, things like quality and valuations and profitability. And the premise is if you lean in towards companies that have exposure to those factors, you can find attractive long-term opportunities. So while this works well and is a sound process in normal market environments, we know that perhaps the most consistent part of our model is that it will underperform in recovery phase. So for forever, really, we had to convince clients and ourselves that this was just rub of the green, that we're still buying sound companies, their day in the sun's going to come eventually. But at some point in the mid 2010s, we decided to challenge that way of thinking. And we thought to ourselves, if this is a very consistent and repeatable part of our process, why can't we take advantage of it? So the solution to that was the advent of something that we call recovery score. And the premise there is that we use the exact same modeling technique that we normally use. We just train it on a different interval in the market. So with our normal model, we train it on past normal market periods, the most recent ones that happened. But with the recovery model, we train it instead on past distressed intervals. So what ends up happening is we get a model that looks wildly different than our traditional score model, and a model that performs exceptionally well during market recoveries. We've now had 2 opportunities to turn this model on in live periods, and both times it's backed up what we saw in the back tests, and that this model is extraordinarily effective. So what you can see here on this chart is the blue chart. That's the highest one. That is how the recovery stocks did starting at the end of March and going through the end of July. The yellow one is how our traditional score model did. And as you can see, that's a pretty sizable gap between the two. And then the gray bar is the one, is how we actually use this in practice. So we always want to make sure that we're owning sound companies and that we can feel good about the stocks that we own in your portfolio. And so we crossed the two. We crossed our traditional score model to make sure we're still investing in high quality companies with the recovery model to try to pick up on some of the momentum that happens during market recoveries. And we crossed the two together like a Venn diagram. And what we see is significant improvement over score. Now I say that we made a big change here because we just turned this model off. And I'm going to put my laser pointer here. And as you can see, our prior coming into this was that the recovery model would remain effective for 2 years coming out of the market bottom. So we're not quite at 2 years, but we've seen a huge move in the stock market. And we coupled that with seeing 2 straight months of relative underperformance out of the recovery model. So in order to be conservative, to make sure that we're protecting your money, we turned this model off. And the reason that we did that is during normal market environments, this recovery model does not work. It's incredibly effective during a recovery phase. It is not effective at all during any other phase in the market. And this is also a time period where we would expect our traditional model to pick up the ball and move it forward again and have success. So that's the big change that we made this past quarter with the stock selection piece. We're about to jump to the Q&A, and I see that we do have quite a few questions there. But real quick, I wanted to call out a webinar that we're doing, as Bijal mentioned a little bit earlier. Will the proposed tax code changes affect you? This is going to be held at the same time next week on Wednesday. Adam Newman, who's normally on these calls, is going to be doing this webinar solo. And I promise by then we'll get our video issues sorted out. But you'll get an email at the end of, by the end of today, inviting you to join this webinar. So please feel free to register and send it to any friends or family who might be interested. Okay, and so with that, I'm going to MC here. We've got some questions that have rolled in. Feel free to continue asking questions if there's something on your mind, and we'll have those roll through. So yeah, it looks like we did have some action here. We've got some upvotes on these questions. So the first question here is, what impact will we see in the stock market because of inflation? So Bijal, I know you covered that one, so I'm going to let you unmute yourself and answer that one for us.
Yeah, I'd say again, if we're experiencing inflation because of growth, that tends to be a very positive thing for the stock market. So as long as we're in that type of environment, I think we would see no concerns, and not that one outlier that we saw in the 70s where we saw a big pullback in the market itself. If they're raising rates because we're experiencing growth and that's where we're getting the inflation from, should be a positive.
Great, thanks, Bijal. I'm going to check that one off. And it looks like we had another question about inflation, so we're going to move on past that one as well. So the next one is regarding supply chains and how they're impacting company earnings in the stock market. So I'll go ahead and take this one. So supply chains certainly, the issues that we're seeing right now with supply chains certainly do have some impact on company earnings. I'm not sure if that impact is really making its way into the stock market as much. And the reason for that is the supply chain issues we're seeing right now. It's more of a demand shock than a supply shock. Central banks have much more control over stimulating or restricting demand than they do over controlling supply. So the fact that it's just way more people than expected are ordering goods and services right now, and that's what's snarling the supply chains, that would be a good reason to have supply chain issues. Not saying a supply chain issue is a good thing, but as far as the stock market goes, as I mentioned before, it's a forward-looking discounting machine. So it's assuming that companies, they're still selling widgets, at a high rate. It's just taking a long time to actually deliver those. So it's taking a while to be able to actually see those earnings come through, the income statement and balance sheets of companies, but it will get there eventually. So there's all this talk about whether what we're seeing is transitory or not. I think right now the expectation is that supply chains will eventually, clear the issues that they're having, and companies won't be restricted by that. But it's certainly impacting company earnings right now, although companies are still producing, we're seeing more earnings beats than is normal historically. But it is having some impact because companies aren't able to actually deliver the things they're trying to sell to customers as timely as they would like. But as far as that impacting the stock market right now, it's probably not that big of an issue. So let me mark that one off. And the next question we have here is about what do higher taxes mean for stock returns? So this is probably in response to the tax bill. And we're going to talk about this next week when Adam does his webinar. But Lowell, why don't you go ahead and take this one?
Yeah, and I'll take the next hot potato one as well, unless somebody else wants to volunteer.
It's all you.
Yeah, so some of the clients on this call have been working with us for decades, and we've gone through various tax regimes. Occasionally they're tightening. The big trend over time has been a decreasing in taxes. Generally, the stock market is immune to those effects. I think the expectations are starting to sort of solidify. And again, Adam will cover this in more detail next week. I don't think that either of the extreme scenarios are all that likely. One being there's no meeting of the minds with the Democrats, and then therefore nothing passes, and therefore nothing to pay for. I think the $3.5 trillion proposition that most of the Democratic Party so passionately wants has no chance, given how staunch the moderate position has been. So I think something in the middle is what we can expect. So if you're a higher earning individual, you're going to get hit. Corporate tax rates will almost certainly get some sort of hit, but it won't go as high as what it was prior to the most recent corporate tax cut. So something in the middle will occur. I don't think either one of those will be material issues for stock returns. And it's just tightening some belts for some. In terms of the vaccine mandates, I do think there will be some labor supply issues related to that. We've already seen Southwest Airlines come off their mandate and their timeline. The economy and individual companies are all going to have to adjust for the fact that this is going to be with us for a while. And at the end of the day, there are people that for a variety of reasons are just not comfortable becoming vaccinated, and it'll work out. So, the short answer is yes, there will be some labor supply issues, but I think that most of the economy being either vaccinated or having recovered from COVID and therefore having natural immunity lessens the risk of this as a variable economically going forward.
Great, thanks, Lowell. So I'll mark that one off as well. But as an FYI, we did have one more question come through, just the chat, which is fine, the chat through Zoom. And it was regarding, if we've turned off that recovery model, why haven't we seen more changes in the portfolio, basically? So I wanted to make sure I got to address that one before we went our separate ways here today. So I like to think of this as a Venn diagram where we've got our recovery model and we've got our traditional model. So what we make sure we do is we buy the intersection of those two, because even during a recovery phase, we want to make sure that we're not buying, junk companies that are just lottery tickets, basically. And so we insist that there is that quality piece to it too, which we enforce by making sure that any stocks we buy, because their recovery rating is strong, they also have a strong traditional rating as well. So you probably noticed in 2020 that we did quite a bit of trading to really implement and really to aggressively implement this recovery model. We don't need to do the inverse of that coming off of the model because we do insist that any stock we own does look attractive still by that traditional modeling process. So what you'll see is you'll likely see some trades in your portfolios that are a result of, this stock was propped up largely because of the recovery stock. And you've probably seen some of that already, being implemented right at the end of this past quarter, and you'll see it again this quarter as well. But we don't need to do anywhere near the amount of turnover, which quite frankly is a good thing, because if you have taxable accounts, we're dealing with a lot of gains right now. So I hope that addresses that question. All right, and so I think that's the end. I don't see any other questions coming through the Slido here. So again, I wanted to thank everyone for joining us on this call. It looks like most everyone stayed here till the very end. So please let us know what you thought of this new process, this new Q&A thing. We're looking for feedback on that. I promise next time we'll get the videos going. One more time, I'll give the shout out to the webinar we're doing next week on the proposed tax plan working its way through Congress. All right, for Lowell and Bijal, thanks everyone for joining us today.